Nothing, and I mean nothing that I have ever said about options means as much as this right here. So if you're not doing this, then I mean there might not be any hope left. So go ahead, roll the clip.
Light the blunt.
Hey, what's up YouTube? This is Foxtail Digital coming to you again with Black Girl Stocks. In this video, we're gonna be talking about stock. What's up everybody? How you doing? I just wanted to say my YouTube plaque just came in. Yay! Stop losses, specifically option stop losses. But of course you can apply the concept to most securities. Oh, look at me using fancy terminology. Okay. But you know, I just mean any investment. So stocks, options, indices. Okay, there's another one. I like that. So yeah, you're definitely going to want to know where to put your stop loss before you even open your trade at all. All right, and I just want to say thank you guys so much for voting for this topic. I asked earlier this week what videos you guys wanted to watch, and this had the majority of the vote. So let's go ahead and go over why you need stop losses, the main types of stop losses, and then how you can start to use them in your day-to-day trading. But first, if this is your first time watching this video, please make sure you click that thumbs up button. It really helps the channel. Also subscribe, click that notification bell so that you get notified anytime I upload a new video for you guys. All right. So if I had to choose just one option trading tool to keep you profitable with your trades, then it would definitely be the stop loss. Setting stop losses is free. It gives you more freedom and control of your trades, and it's going to allow you to keep your emotions in check when you're trading. And I know keeping calm can be difficult. So you can really think of stop losses like insurance for your trades, and no, nobody really wants to use the insurance, but in the chance that your trade goes against you or your life, then you'll definitely be happy to have that cushion there. So let's just say, for example, you open a call option for 1.50 premium. Okay, so $1.50 premium on a stock that you feel is gonna go up, and then boom, all of a sudden the vice president makes a huge inside trade and sells $14 million worth of shares that morning. So all of a sudden the option value drops all the way down to 0.95 that day. But if that was you, then clearly having a stop loss set to 10% from your entry would have sold that option around 120 or somewhere around there. So you see how having a stop loss can keep you from blowing up your trade or even your entire account and going into shambles, okay? So stop losses are definitely important. The textbook definition of a stop loss is an order placed within your broker to buy or sell a certain position once the stock reaches a certain price. And that's going to be our stop price. And its main purpose is going to be to limit your losses in long positions. And then it's going to automatically close a losing position for you, so you don't even have to think about it. Like we said in the previous example, setting a stop loss maybe 10% below your entry price is going to limit your potential loss to 10%. So instead of losing that full $150 that you paid for the premium, you're going to cut your losses at $15. You see where we're going here? This is critical. All of your trades, you need to put a stop loss on it if you're going to be holding it for any amount of time. So in a lot of platforms, when you're looking at options, there's going to be two main types of stop losses. So you're going to see the stop loss market order and then a stop loss limit order. And I really want to make sure that you know the difference in between the two of these. All right. So the stop loss market order is going to protect the long positions by triggering a market sell order if the option price falls below your set price. So let's say, for example, you have an option open for stock XYZ for $2. So $2 premium, and then you're going to set a stop loss at 1.75. So if the option value drops down to 1.75, then it's automatically going to do a market sell order and sell it at the best market price at that time. That's not to say that it's going to close exactly at 1.75, but it's going to be the best price that it could get at that time. So that could be 1.72 or 1.74. It really depends on the market volatility at that time. Now, the stop limit orders are very close to stop orders, but instead of an automatic market order, there's going to be a limit on the price that they're going to be filled. So the stop limit order is going to have two prices. You're going to see the stop price that converts the order to a sell order, and then below that you're going to see the limit price. So instead of a market order to sell, it's just going to do a limit sell order, and it's only going to sell at the limit price or better. The limiting aspect of the stop limit order is that it may not happen at all. So it might not get filled with the stop, with that type of order. So with the stop loss market order, you're guaranteed to get out of that position. It might not be at the best price, but it's definitely going to happen. So it's good to give yourself cushion if the price falls below the limit, and you're going to want to give it a little time to see if that price goes up again. So in really volatile markets, the stop limit may be your best bet, because let's say if you just had a regular stop and it does drop down to that price, but it could rebound back up quickly. It's a volatile market. Now I'm going to show you how to physically set stop losses. In this example, we can use Robinhood. I'm going to show you how to do it in Robinhood. So you're just going to click on trade and click sell. So this is one that I already have open. Now you're going to click up here to this little settings little thing up here in the top right, and you see here stop price. So this Robinhood is automatically going to be a stop limit order. So you see here you have your stop price 84 cents, something a little bit lower than what it is right now, 80. That's going to be the price. Once that stop price is triggered, it's going to do a limit sell, which really gives you room, because let's say if the stock price went up, then it could do that. So 0.75 or something like that. Boom. And then for Webull, so if you're going to do one, this is one that I already have. I already have this option in ABT. You're going to go to your order type, opportunities. They give you more in Webull. Everything's always going to be better in Webull. Webull is just the best, but you have stop here and then you have stop limit. So you see, boom, you can do that right there. Just put your stop there. So right now it's at 0.73. I might do it at boom. And this one I like. You can do good until canceled. So I know the next question that you're going to ask is, where should you set your stop limit? So I'm going to say that that's completely subjective, and that is up to you. So that's going to go into your risk tolerance and your personal trading style. And then there's a lot of ways that you can go about knowing where to actually set up your stop losses. Okay. So one good way is to use the percentage method, just like we talked about earlier with the 10%. So this is where you're going to pick a percentage to set your stop losses. Long-term traders may be more comfortable with fluctuations and with the stock price, so they're gonna set their stop limit somewhere around 10, maybe 20% before cutting those losses. But more short-term traders, we probably feel more comfortable with limits as low as 2 to 5% to put our stop losses, because you know we're doing fast-paced trades. So definitely a small loss is gonna be better than a big ride down. So one of the biggest disadvantages of using stop losses are gonna be short-term price fluctuations in your options and stock prices. So I know when you have options, especially with higher priced options, there's going to be a big spread between the bid and the ask. So that could give you problems also. So you may set your stop a certain percentage from your entry. Let's say the stock drops a little bit, normal pullback, nothing too much, and then your stop gets triggered, and then the stock jumps back up in price. That's what I would call a good old fake out. So you kind of want to be safe with that. Give yourself some room for pullbacks. Oh, and this is really important, because I had a Zoom meeting with my guy Lucas. Shouts out to Lucas. What's up, Lucas? But on some platforms, for those of you who love to do the spreads, the debit spreads, credit spreads, iron condors, and everything like that, on Robinhood, and you're not able to put stop losses on spreads. So you know, that's something to keep in mind before you get into the trade. Just know you're not going to be able to put stop losses on those. And yeah, so guys, please make sure you guys check out this video I have about Tiblio, how to use Tiblio, how to go about it using the Discord and everything like that. I know a lot of you guys trading options love Tiblio, so this is going to help you. And also make sure you sign up to Tiblio using my link for 20% off down below. All right, so shouts out to Tiblio. Check that video out. All right.